and welcome back to Pandemic Proofing Your Portfolio on the Wizards of Dalal Street. I'm Ramesh Tamani. With me today, a trifecta of Generation Next of Dalal Street, Manish Bhandari of Valem Capital, Rahul Rathi of Punartha Advisors, and Charandeep Singh of Girik Capital. Manish, it's your turn now. You've been worried before even the crisis hit us in February, March about equity valuations in general, and you were bullish on gold. Given the fall in the market, are valuations more attractive? Are you more bullish now? And what is your view on gold?
Mr. Damani, price sometimes is just like a noise. So you have a market which is moving up by 10% in a week or 10 days. So it's really difficult for a value investor to really pick and say that today is a value and tomorrow is not a value. But gold is something which I've been advocating for some time, even our last investor letter as well as this investor letter, that if you look at from a top-down approach, the global monetary base has expanded at an unprecedented rate. And in that context, if you look at the gold versus the global monetary order, which used to be close to 4.6 trillion, and the global monetary order was significantly higher, and today close to 7 or 8 trillion. That's the total outstanding size of the gold to a global monetary order of close to 40 trillion or so. So I find a disconnect with that gold, an asset class, is highly underappreciated. And the noise surrounding equity usually take the sheen away from the gold. And from an Indian investor point of view, this gold becomes a very interesting hedge against the depreciation of rupee. So you are landed up in making 4 or 5% annual depreciation in rupee through the gold. So I would strongly advocate that if someone as an investor is underallocated on the gold, this may be the last train to buy some of it. So I would be significantly overweight. We played through buying the gold-linked loan companies, which gives a loan on the basis of the gold from last year onwards, and it played out to be a very interesting play for us in some time.
Manish, that's an interesting point because Warren Buffett said, well, you can look at gold, you can fondle it perhaps, but it doesn't give you any dividends. The large transaction cost to hold it. But the point I want to argue with you is that, are you betting on yesterday's asset class? Are the more digital savvy consumers, the people who don't trust central banks, as you say, going to go to Bitcoin rather than gold?
Very interesting. Buffett did said about it that you keep a piece of gold on a table, it will remain the same and the company would give you a dividend. Answer is yes. But I want to strongly advocate that gold should be given a Nobel Peace Prize to act as an arbiter in a situation where you have an unprecedented monetary disorder and dislocation. So what works in favor of gold today, if you have a zero interest rate in a global regime from an economy like the United States of America, then the holding cost of the gold goes down substantially. So and you have an interesting question that is the gold for the new generation, for the digital savvy consumer or not? So you have a two set of consumers in the world. One who would, one age who would own a gold, and the new set of consumer will own Bitcoin. So both these consumers are telling you that one want to own a gold and another want to own a Bitcoin. Answer is yes. So, but both asset class, gold has a history of a trust with the humanity for maybe 2,000 years or so. So it's not going to go away so fast. And gold peaked in 2012 and 13. Until now, we are below the 2013 peak, and the world has moved significantly during this time frame. So I would say
inflation hasn't moved, Manish. Inflation hasn't moved.
Pardon?
Inflation hasn't moved. I mean, gold has not moved because inflation hasn't moved. Normally, it's a hedge against inflation, right?
Yeah, you are right. You are right. The inflation has not moved. But so the cost of capital has gone down substantially. So earlier, there used to be a cost of capital to store a gold and to own a gold. You would have earned a treasury, far better return in the US treasury, if I have to look at versus this. But let me remind you, Rameshji, this year, post the crisis, if I'm not wrong, there are only two asset classes which have done significantly well versus most of the financial assets. And relative to all the financial assets, one is gold and another is the US treasury. So there are times when gold will do very well. If you have to stretch your imagination and have to see that how the gold would have done versus on a 20-year log scale or maybe a 30-year log scale, I'm sure it will beat most of the financial assets also significantly. So there is a strong case to own a gold or a gold-linked product if someone could definitely look at that.
All right, Manish, let me pull you back to equities. You clearly recommend equities that are impacted with gold or gold lending as a good example. Where else are you finding opportunities? Have values come down enough that you are finding values in other sectors? I always remember your great example of the 2008 when Airbnb was becoming mainstream, that you bought the linen companies of India. So that was a great play. Any such ideas that you can share with us?
Yeah, three sectors in a post-COVID world looks interesting to me. And one of them, to start with, the first one is the pharmaceutical industry. It's a $14.5 billion export-oriented industry. And after the post-COVID, one of the significant investment, if the world has to see, is going to happen in the medical and the medical services across the world, whether it is the developed world, or the emerging world, any part of the world. And India stands a very interesting chance and a significant chance with a competitive advantage to advocate the cause of the pharma industry. And we are leader and we are gaining enough traction. So I see a situation after 4 years of difficult times, the pharma industry will be a significantly beneficiary in this process, and where the export as well as the domestic market both are doing reasonably well. So we got invested last year in the pharmaceutical industry in the process. Another area which I look at it at this point of time, where there is no supply disruption or there is no demand destruction, and that's going to be a fundamental reason for anyone to evaluate a company at this point of time or industry at this point of time, looks to me is an agriculture. So if I have to look at the agriculture industry from the India perspective, then we have an interesting dynamics where the agriculture, where even if you talk about from the lockdown perspective, the agriculture has not seen so much of disruption. If I have to look at from the government's viewpoint, as well as from all the efforts they have made in last half a decade or so, is to correct the balance sheet and correct the situation at the agriculture side. So agriculture, and as well as agriculture as an industry is a big exporter out of India also. So you will have a situation where the food security is going to be of prime importance, and agriculture and the agriculture linkages within the India, and those companies are going to be a beneficiary. And the third one is going to be the rural spending. So I see the coming back of the rural India in a far better way versus the coming back of the urban India.
It's the urban versus rural divide that is true in America also, that rural sectors are Trump supporters, urban sectors are Democrats, and we're probably going to see a divide here too, you think. Let me ask this to all of you, but I'll start with you again, Manish, just to round it off. You have an investor base. What is the retail investor doing? Are they putting money? Are they withdrawing money? Are they panicking? What has been your experience with your retail base? Manish?
So yes, yeah. So you have a mixed reaction. The people who are joined the party for the first time, I mean to say people who are not less than a half a decade investor. So let's bifurcate investor between the people who have seen 2008 and who have seen a decade of investing. They are taking this far more calmly. Obviously, people do want to see their portfolios going up, but they are far more mentally suited and temperamentally suited to handle such kind of dislocations. People who have come in after a 7-8 year of bull run and who have joined the party in last 2 years or so, they definitely will come to a new reality that whether this is not a market where you can make money on an equity doesn't compound. On a log scale of 20 years, you do look at it compounding, but that compounding doesn't happen in patches of 2 years or 3 years. Let me remind everyone and all the viewers, Damaniji, that after the 2008 crisis, 2008 and 9 crisis, and after the normalization, the BSE index, Sensex, didn't move up for 4 years in a row. So if investor do look at investing in the Indian equity market with a very short horizon or a temperament, then they could be in a situation where they could be slightly in disappointing position. We have chosen our investors far more carefully.
Okay.